We're going to talk about the VA loan. We're going to explain in detail what that process looks like so that you feel more comfortable and confident when you talk to an agent and or lender, primarily lender, I guess, for VA loan, but agents are important too. We'll talk about that. And we're going to dig through the nuts and bolts. First and foremost, choosing a lender. Now, there are some perks and pros and cons to all different sorts of lenders. I'll talk through, I'm not going to name anyone specifically except for the company that I recommend and work with a lot. But I will kind of talk through some different things. First and foremost, it's good to shop around at the pre-qual stage and kind of ask for terms and like a basic understanding for kind of where you're going to come in at for rate and pricing. Right now, pre-qual and pre-approval are totally different. Pre-qual is like the basic, here's my info, what do you think? And pre-approval is the actual like credit run, thing. So don't do a million pre-approvals, but do some pre-quals, talk to some different people, kind of see what your options are. That'll help you out. Now, different lenders, this is important with the VA loan. The VA loan has very few real like hard no limit stop guideline things, right? It is pretty lenient. For example, no credit score requirement. But every bank is going to have their own credit score requirements. So some are as low as 500, others are going to be 580, 620, really depends on the lender. So I say that just to say, if a lender tells you no, you're not qualified, it doesn't necessarily mean you're not qualified per the VA loan. It means potentially that you're just not qualified per that lender's overlays or additional requirements. So you can ask them, is this a company overlay or a guideline? They may answer, or they may just try to steer you towards another product, or you can just go research the guideline, or heck, shoot me a message on Instagram and I'll point you in the right direction. But, all right, so talking to a lender. Big banks offer some perks, I suppose, because they're well known and they're trustable and yada yada, but ultimately they're slow. They often don't close on time. They have additional fees a lot of times, hidden fees. There's a lot of things that go into running a big bank, right? A big like corporation style bank versus like a mortgage broker or a smaller lender or whatever. Now, not all mortgage companies are created equal. So just because a mortgage company has a really good lender who understands the VA loan doesn't mean that the entire company does. Prime example, not going to name the company, but a company that a guy that I lived with for a year was a lender with, he was amazing, right? He was a veteran, is a veteran who took a ton of time to really research the VA loan, could do anything. That doesn't mean that every lender in that company is the same way, right? So kind of understand the differences. You need to find a person who is extremely knowledgeable and talented with the VA loan, more so than you need to find a company who offers the VA loan as a product, right? There are different products available, different companies, and you can search, like some companies will do the one-time build, or one-time, I forget the official term. Anyway, basically like one-time close. Anyway, basically like a purchase of land to build a home with the VA loan, zero down. That's a thing, but not all lenders do it. The VA renovation loan, where you can buy a house that needs to be fixed up and fix it up, that's a thing as well, but not all lenders do it. So you need to shop around for what product you're looking for, different lenders, yada yada. Personally, I recommend and utilize a few different people depending on where you're at. And if you'd like, I'll leave a link down in the comments and in the main description of the video, pointing you to a spot on my website where you can fill out a little questionnaire about kind of what you're looking for as far as like location, purchase price, timeline, whatever. And I can introduce you to the lender that I personally love in that area, because it's going to vary, right? Like I said, different companies. So in California, I have a really good friend who's phenomenal. In Texas, my buddy Chris is an amazing, amazing lender who actually runs a team of that helps coach people through VA loans and becoming really qualified mortgage brokers. And then from there, depending on where you go, Chris has an entire network of really amazing people that I would gladly introduce you to in all of these various markets, right? And then that's, so happy to do that. Shop around, find yourself a lender, right? Get pre-qualified, talk to a couple different people to see what your options are, make sure you find someone who fits what you're looking for. Choosing an agent, I know this doesn't technically have anything to do with the VA loan, but this is, having an agent who understands the VA loan will be very, very helpful compared to the opposite. So there's this stigma that the VA loan seems to have in some markets where agents and lenders will be like, oh, you know, it's not that great, or it's not the best loan, or whatever. Wrong. The VA loan is without a doubt the best primary residence mortgage product out there. And if someone's telling you that you can't get that loan approved, or you're not going to be able to get a house under contract or whatever, that's not a reflection on the product, that's a reflection of them as an agent and or lender, right? So I can tell you right now that my buddy Donnie, who was Rookie of the Year 2 years ago and a top 3 realtor in San Diego County this year, has closed a crap load of VA home loan properties as an agent in San Diego, one of the hottest counties in the country, through the pandemic, one of the hottest times that San Diego's ever had. And he was closing them left and right. My buddy Tobin in the DC, Maryland, Virginia area has closed 15 or 20 for people in our community over the last 2 years. Also very hot area, very hot time period. Hawaii, Austin, Dallas, Seattle. We have closed, people that I know and have introduced have closed a ton of real estate with the VA loan in all these different areas, because they had an agent who knew what they were doing and understood the ins and outs, and was paired with a lender who also did. If you have the right professionals on your team, this is a cakewalk. If you don't, they're gonna try to talk you out of it. Red flag. So again, same with the lenders on the agent side. If you'd like that introduction, you click that link. That form has an option for whether you'd like an intro to an agent, a lender, both. Full disclosure on the lender side, I get nothing because there's no way to do anything there. On the agent side, if you buy a house, I will get a small piece of that agent's commission. You will not pay me, they will, and it comes out of the seller's pocket. So it's a win-win, but just something I started doing once the platform grew so big that like every day I was sending 5 or 10 introductions, and finally one of my buddies was like, you know, I could give you a small piece of my check as a thank you if you got licensed. So here we are, but nonetheless, they're phenomenal. We've closed, $40 million, $50 million worth of VA loans in the last 2 years for people in the community. So pretty sweet deal. And again, you don't pay for it. I don't get anything unless you buy a house and it doesn't come out of your pocket. So anyway, all right, debt to income with any other loan, 50% is your cutoff on the primary side. On the VA loan, there's not actually a cap on the guideline. Again, this might be something where there's overlays, but your debt to income, I've seen mid 70s, high 70s for debt to income on duplex, triplex, fourplexes that were in expensive areas and being house hacked. So it's very possible, not necessarily recommended to go that high, but it's doable. You don't have to have money for a down payment. There are some, you know, depending on how you look at it, some people are like, oh, if you put 5% down, you pay a smaller funding fee. I don't really think that works out. I don't really think that works out in your favor because the funding fee is so minimal. You're talking $11 a month for every $100,000 you borrow. So if you borrow $100,000, I would rather pay the $11 a month than put $5,000 down, right? Because, I mean, do the math on how many months it's gonna take you to recoup the $5,000 down. Oh, and by the way, the $5,000 down will probably only take that $11 a month and move it to like $7 or $8 a month. So yeah, not worth it, in my opinion. Opportunity cost too big, invest the 5 or use it as a cash reserve. But overall, you're not gonna have to put any money down using the VA loan. That's one of the great perks because it allows you to get into a house more affordably. Kind of touched on the funding fee already. On your first use, it's 2.3% of the loan. On the second use, it's 3.6. That's added onto the note. So, and if you're 10% disabled or have a Purple Heart, it's completely waived, but that's added onto the loan, right? And it comes out, the 2.3% comes out to like $11 for every 100,000 borrowed, which is much cheaper than mortgage insurance premiums and private mortgage insurance, MIP, PMI for like the FHA or 5% down conventional loan or USDA. And it's also way better opportunity cost wise than putting 20% down on the property just to avoid the funding fee, right? Like, or use a conventional loan. Like, no way. VA loan blows it out of the water. The funding fee is not that big a deal. Don't get wrapped around it. I've got a ton of other content specifically about that, but I don't think it's something to really freak out about. The loan is still a better product than anything else in the market. Closing costs. You should budget 1 to 3% for closing costs. Now, with the VA loan, the seller can cover your closing costs. So let's say the house is $100,000 and you say, hey, I will give you I'll offer you $104,000. Will you give me $4,000 back for closing costs? If the seller says yes, and the house appraises for at least that 104, then you're good, right? That totally can work. It's not a guarantee though, so I always recommend that you budget the 1 to 3%, preferably 3% or 4% for closing costs, just to make sure that if anything comes up, you're covered, there's no surprises, you get like a week out from closing and realize you don't have the money to close on the house, right? Not where you wanna be. Better to budget for it and then have the seller cover it than not, especially in like a really hot market like we've seen the last year or two. A lot of sellers aren't covering that, right? But market shifts might become very common again. One other thing that's worth noting is the VA IRRRL. So what this allows is you to, without running credit again and financials again and requalifying for a refi, after 210 days, you can do what's called a VA IRRRL. That's a VA interest rate reduction refinance loan, which basically means that if your interest rate is low enough that it saves you money, then you can just refi into the VA IRRRL and bada bing, bada boom. Now, this is awesome because it doesn't matter if you live in the house anymore. It doesn't matter if you're qualified for the mortgage anymore. None of that matters. If the house is still owned by you and it's still under a VA loan and the rate is lower, like there's a metric there where it has to be like you have to recoup the cost of refinancing within 3 years or something. Like there's a specific, like you're not allowed to do it unless it actually saves you a certain amount of money. And then as long as it saves you that certain amount of money, you can do the VA IRRRL. So it's sweet. So like in 2020, people who had bought a house in 2019 and the rates plummeted got to use the VA IRRRL to refinance. I was helping friends refinance properties that they had moved out of. A buddy of mine, stationed in Japan, had a property in the DMV, like DC, Maryland, Virginia area, and it was a rental, and used the VA IRRRL, lowered his rate to like 2.5, 2.25, whatever, while living overseas, and just increased his cash flow on that property. So it's an awesome product, but what it also does, and a lot of times people don't think about this, is rates right now, this is July of 2022, are higher than they were in July of 2021, and people are kind of spooked about it. So there's two ways that you can go about this. You could just not buy and hope the rates come back down, and if they do, great, and if they don't, well, then you're screwed because you should have bought now. Well, that's all well and good, but with the VA loan, what you can do is you could buy today, and if rates go up, then who cares because you locked in that rate because you bought today. And if rates do go down, then you just use the VA IRRRL. So you make the payment for 210 days, refi into the lower rate, bada bing, bada boom, you're golden. So it's a great hedge in which you can only have your rate go down, it will not go up. So if you're on the fence about using the VA loan, I encourage you, go ahead and do it. If the rates do go down, use the VA IRRRL. If the rates do not go down, then you're better off having bought now than you are when rates go up another 1 or 2%, or 3, or 5, or 10, whatever, right? No one knows what the market's gonna do. So that's my thoughts on that. I mean, the basic process is simple. You talk to a lender, you get pre-qualified so that you can look at houses and whatever. Once you're getting close to writing an offer, you get the actual pre-approval done once you've picked out what lender you're going to use, and then you go through all the documents that they're going to need. There is a lot of red tape whenever you use primary residence mortgages like the VA loan. That's just the nature of the beast because it's federally backed by, like the government's guaranteeing 25% of your loan. It's not the lender, it's the underwriters and all this. So be a little patient because they're gonna ask for something, then they're gonna ask for something else, then they're gonna ask for something else, and some of it's ridiculous and some of it's stupid. To put this in perspective, at the time, last July, I owned $3.5 million worth of real estate, 100 doors, cash flowed, financially free, whatever. My tax returns showed a loss because of depreciation and it's just how the game is played. And not a loss per se, but just not a lot of income. I was leaving the military, so I wasn't gonna be able to use my military income to qualify for the VA loan. So while I make more money than my spouse, I was dragging us down on the VA loan. I had to gift my wife 5% down to buy this house so that we could use a 5% down conventional loan with only her name on it so that my finances were not involved at all in order to qualify for the loan. So here I am with a bank that will lend me literally millions of dollars for real estate, telling me they can't lend me on this property because it's a VA loan. So that's how wonky sometimes primary residence is, and I wouldn't have been able to get approved for an FHA or a conventional or a USDA because of the exact same thing. So just know they're gonna ask you for some weird things, and it's, you know, it is what it is, right? That's underwriting. You go through, you talk to them, blah, 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 you show up with closing costs, you buy the house, right? That's pretty much it. Now, what to look for in a lender and an agent. Somebody who understands the VA loan, is confident, and has proven that they can get you approved. But on the loan side, rate is not always king. Don't get me wrong, there are, again, you can do the VA IRRRL later, and you can do that with another company, right? It doesn't have to be the same company. So I would rather work for a really, really good lender who will stake a claim on closing quickly and efficiently and on time and doing the right thing and actually succeeding than banking solely on rate. So prime example, when my buddy was working with this company, now he's a 7-figure wholesaler and a flipper, but when he was working with this company, people would shop and they would get better rates and they would go, and then they would come back because of the service or the inability to close. We were saving loans from other companies left and right, including companies that specialize, quote unquote, in VA loans and are military real estate lenders and whatever, that weren't able to get it done, and he was, right? And to point, I've seen him close a loan in 14 days, the VA loan. He was willing to guarantee a 17-day close or a 21-day close or whatever to get those loans done. Like, he would literally, I've seen him make a phone call and say, yeah, hey, this offer just got submitted, I'm doing the loan, I guarantee you we can close in 17 days, and if we don't close for any reason on my end as the lender, I'll pay you a per diem, which in San Diego is like $240 a day, every day until we close, right? And I don't think he ever paid the per diem. So get you a lender who's that confident and will over communicate and make sure you're taken care of. And then if the rate is, you know, a quarter of a point higher, it's better than not getting the house. And you can just do the VA IRRRL down the road if rates are still low or lower, right? Like, it doesn't matter. A quarter of a point is peanuts on most loans. So yes, getting a low rate is good. I don't think it's the most important aspect. I see service members and veterans get burned all the time by unnecessarily high closing costs and fees. So know this. It is entirely possible for a lender to give you a great interest rate and still be the worst loan option because of these fees. Now, that is why you need to know what you're looking at when it comes to receiving loan closing costs and documents. So first off, what are closing costs? Closing costs are the myriad of fees that you pay when finalizing a mortgage. Now, anytime you purchase a home or refinance, you will be subjected to paying closing costs, unless of course you get the seller to pay them all as a part of your negotiations, which is possible. Now, how much are loan closing costs, right? So they're generally going to range between 2 and 5% of the loan amount. So on a $100,000 mortgage, you'd be looking to pay between $2 and $5 grand for closing costs. The most affordable way to cover your closing costs is to pay them as a one-time expense, right? There are times where you can wrap the closing costs into the loan in order to finance them, but then you're going to be paying interest on them for the entire duration of the mortgage. So, you know, that's more expensive, but it might be worthwhile if you didn't have the cash for closing costs, or you couldn't negotiate them out of the sale, and then financing them was still, like, you'd still cash flow. It might not be as great a financial decision long term, but you know, it is what it is. Now, sometimes you can negotiate with your lender, or you can shop around with different lenders to lower your potential loan closing costs. My favorite way to lower closing costs, though, is to convince the seller to cover some or all of them. For example, let's say you have a home on the market for $100,000, and I offer you $10,000 under the asking price, so $90,000, and then you counter back at full price because you think it's actually worth $100,000. I may agree, but then say, hey, but I want you to cover all the closing costs by doing this. And by doing this, I'll have a little more on the mortgage than my original offer, but I won't have to put nearly as much money down, so the numbers could work out for me better. Now, when do you pay closing costs? You will pay the loan closing costs at the end of the loan process, otherwise known as closing day. These costs can be prepaid at closing or wrapped into the loan, depending on what fits your financial situation the best. There are recurring and non-recurring closing costs. So recurring costs are those things like mortgage interest, principal interest, taxes, insurance, annual fees, and any costs associated with the loan that is paid continually throughout your ownership. The first of these is mortgage insurance fees, right? So mortgage insurance is required on any loan that you pay less than 20% down for, with the exception of the VA loan. Another reason the VA loan is incredible. Now, sometimes the first year of this fee is paid up front, but more often than not, private mortgage insurance with PMI is tacked on to your monthly payment. If you use an FHA loan, you'll also be required to pay a mortgage insurance premium. So, just make sure you're aware of that. Now, they're all fairly standard fees. Just make sure you understand what they are up front from your lender. You're always going to have to pay property taxes, annual fees, insurance, whatever. Just make sure you get with your lender and you understand what those look like. So property taxes, your lender may require you to pay 1 or 2 months of them up front when you close on the property. But either way, you're going to be paying property tax for the duration of ownership, unless you're in like a state that waives them for disabled veterans or something like that. Annual assessments. So if you're purchasing a condo or a property with a homeowners association HOA fee, they may require annual fees or monthly fees. In fact, I don't know any HOA that doesn't have some kind of fee. So just know that you need to be aware of that. Homeowners insurance premium. Your lender may require you to carry homeowners insurance on the property to protect their investment. In fact, I'm pretty sure they will. As you can expect, these insurance fees are recurring for the duration of ownership as well, because you're insuring the property. And then non-recurring fees. In case you can't put 2 and 2 together, I'm looking at you, Marines. You have probably figured out that non-recurring fees are in fact not recurring. These are the loan closing costs and fees that you pay up front and you should never have to pay again, right? So the first one is property related fees. This is things like your home inspection. Whenever you go under contract on a property, one of the first things you do is order a home inspection to make sure that your investment is a good investment. Most lenders actually require this, but it's a good practice to order a home inspection regardless until you get really familiar with what you're looking at and you're comfortable with assuming that risk, right? I don't recommend that right off the bat. Before lending you hundreds of thousands of dollars, the bank wants to ensure that the property is structurally sound. You should too. So inspections will vary based on what kind of property it is, and how big, but they're generally average between $300 to $600. Next up is the appraisal fee. Lenders also want to confirm that the property is actually worth at least as much as you're paying for it. So for this reason, you will need to hire an appraiser anytime that you apply for a loan to purchase a home or refinance. Loan-related fees. These are the fees that lenders have more control over, but they can fluctuate a little bit. So there's things like the application fee, which is used to cover the processing, the cost of processing your request or your application for a new loan. So that's going to cover the costs associated with like your credit checks, your administrative requests, and whatever. Obviously, these fees will fluctuate based on the lender and their processes, but the fee is basically just passed through to you so that the lender doesn't have to pay any fees associated with processing your application in the chance that you don't actually qualify for a loan or even use them. So yeah. All right, the assumption fee. This only comes into play if you're assuming the seller's mortgage, and if applicable, this fee would be based on the value of the remaining mortgage balance that you're taking over. And then there's prepaid interest. So let's say you close a loan on January 15th, but the first mortgage payment isn't due until March 1st. In this scenario, the lender will most likely charge you upfront for the interest that occurs between the day you closed and the first monthly payment, rather than tacking it on to the first payment. Now, loan origination fees is the next one, and this can be a beast, so you never know, right? These are also known as the underwriting fee or the processing fee or sometimes the administrative fee. In essence, this fee is one of the ones you really need to pay attention to, because this is one of the fees that lenders can tweak, they can overcharge for, or hide expenses to give you a lower rate, so that in essence, they could lower your rate, put a bunch of stuff into your origination fee, like buying down points or whatever, and they might be able to hide it there. I've seen it. You should expect to pay between 0.5% to 1% of the loan cost in origination fees, or like $500 to $1,000 on a $100,000 mortgage, right? Now, attorney's fees. Your state may require an attorney present at the closing table, and that would be another fee associated with their time. So the number of hours the attorney's at closing will determine how much this costs. And then there's a mortgage broker fee. So if you work with a mortgage broker to find a loan, instead of with a direct to seller lender, they'll often tack on this fee as their commission for helping you find the loan. So this commission generally ranges from 0.5% to 2.75% of the home's purchase price, and that's something you should iron out before working with a mortgage broker. Also, when you're going to work with a broker instead of like a direct to seller, Be aware that brokers often take a little longer to process loans, and it's not their fault. It's just that they have to work within the confines of whatever wholesaler they find, instead of having like everything lined up in their system where they control the pipeline. So it's kind of a normal thing. Discount points. By paying discount points, you can reduce the interest rate you pay over the life of the loan. Sometimes that's absolutely worthwhile, and sometimes it's completely unnecessary. It's going to depend on the size of your loan and the interest rate you're qualified to lock in, and whatever. So one discount point equals 1% of the cost of the loan. So if you pay 2 points on a $100,000 loan, then you will be paying $2,000 to buy down that loan interest rate. So that's going to make more sense the longer you plan to stay in a home. So the longer you plan to stay in the home, the more valuable buying down the rate generally is. And then there's title fees, which are what the title company will charge to ensure that you purchasing a home with clean title. Now, the lender is going to require you to run a title search and probably get title insurance. I recommend it anyway, and that's just for qualifying for their loan. But title search fees, title search is conducted to ensure that the person selling the home is the legal owner. Right now, I am currently dealing with a home that I'm under contract on. I wasn't able to close on Friday because the person who owns the home had tried to seller finance it to somebody else, and they need to quit claim it back into his name to sell it back to me, and that hasn't cleared yet. So the title search and everything is there to protect me. It also verifies that there's no outstanding claims or liens against the property, so that can be fairly labor intensive depending on how well kept the real estate records are. Title search fees generally hover around $200. It can vary around the title companies in your market, so just take a look. And then there's owner's title insurance. You'll probably want to consider paying for title insurance to protect yourself against any issues that arise with title after closing. It's rare that these issues will arise, but you never know, and title insurance is not that expensive, generally like 0.5 to 1% of the purchase price, so it's definitely worth looking into. Lenders title insurance, most lenders are going to require a loan policy which protects them in case there is an error in the title search, so if lenders want it to protect their investment, you probably should. And then here's kind of a summary of mortgage closing costs. So here's an average breakdown. Again, it's average, and this is going to change based on years and all kinds of in market and all kinds of stuff. But and lenders. But here's kind of the average of what to expect. The appraisal fee, $300 or $400. Home inspection, $300 to $500. Application fee varies. Assumption fee varies. Attorney's fee, hourly. Depends on how long they're there. Prepaid interest, it's going to be based on the loan amount. Origination fee, about 0.5 to 1% of the loan. Discount points, 1 point costs 1% of the loan amount. Mortgage broker fee, 0.5 to 2.75% of the loan amount. Mortgage insurance application fee, it's going to vary. Upfront mortgage insurance, 0.55% to 2.25%. FHA, VA, and USDA fees, 1 to 3.3%. Property taxes, 2 months worth. Upfront HOA fee, it's going to vary on your homeowner's insurance. Depends on the home value and the location. Title search, about $200. Lender's title insurance, varies. Owner's title, insurance, 0.5 to 1% of purchase price. Look, junk fees. You need to avoid junk fees or garbage fees that are tacked on to most mortgages. There isn't any way to completely ignore these fees, but you can at least minimize them most of the time. So look for unnecessary processing and documentation fees in the below categories, right? So application fee, mortgage rate lock fee, underwriting fee, broker rebate, loan processing fee. Just make sure that you're aware if there's some large inflations there and then your interest rate is still low. The bottom line is this. You owe it to yourself to scrutinize the closing statement and all of your loan closing costs and fees. You need to know exactly what you're paying for and how it's going to compare to other lenders in your area. Now, I'm not advocating for rate shopping lenders after you've worked with a lender, with them for weeks on end, but I am saying you need to make sure that you aren't getting bent over by the lender at the same time. A lower interest rate doesn't always mean a more affordable loan. Make sure you look at everything objectively and not just the interest rate. People get so wrapped around what their interest rate is that they neglect the fact that the fees may be a lot more. So look at the APR, look at the fees, make sure you're comparing apples to apples. I have a roommate who does VA loans, and I have watched people go with another lender for a worse loan product that just had a lower rate or whatever, and they thought it was a better thing. And it's so frustrating because it's like, this person's getting screwed. They don't even know it. And often it's even more frustrating because like this guy spent weeks working on your thing. I've even watched where
Like, he's walked them through all the mistakes that their lender went with, and then they still go with the other person. I don't understand. So just make sure you're getting the best deal for yourself, and remember that relationships are important. So make sure you make good decisions. Have you ever wrongly heard that you can only use the VA loan once? In my longer article and series of videos about the VA loan, I tell how I have missed out on over $10,000 due to a lender talking me out of using the VA loan because he said I couldn't use it more than once, or whatever. Like, it was just, yeah. These are the most common justifications you can use to buy a second home with the VA loan. Moving due to work, whether that's a PCS or after the military. The Department of Veterans Affairs understands that you will get moved around a lot while in the military. For this reason, you are able to use the VA loan again when you PCS. The same holds true if you are out of the military and you get relocated due to your job, assuming you move over 50 miles away. Obviously, if you quit working at McDonald's and then begin working at Burger King in the same town, you cannot buy the home next door to your current home. The intent of the VA loan is to help service members get into homes, not buy entire neighborhoods for 0% down. The second reason is upgrading to a larger home because of a growing family. If you have more kids on the way, you can upgrade to a larger home. For example, if you live in a 2-bed, 1-bath and have a second or third kid on the way, in this instance, you would be able to use the VA loan again in order to upgrade to a 3 or 4-bedroom home. A third reason is purchasing a smaller home due to financial distress, divorce, or loss of dependents. If you find yourself unfortunately in financial distress, divorced, or with fewer dependents for whatever reason, then when you purchase the current home, you can purchase a smaller home to downsize your costs. I hope you never find yourself in any of those situations, but it is nice to know that you can downsize to provide a lower cost of living for yourself. Fourth way is after selling the first home you purchased with the VA loan. Now, this one's straightforward, but if you sell your home, you can buy another home with the VA loan in your area. Ta-da. The fifth way is after refinancing your home into a conventional loan or out of the VA loan. So you're also able to refinance your home into a conventional mortgage once you have enough equity in the home, generally 20%, but that differs from lender to lender, right? Now, if you refinance out of the VA loan, you are free to use it again in your area. Now, there are some other stipulations, right? So the bottom line is that if you can articulate why you need to use the VA loan a second time to your lender and they sign off on it, then you'll be in the clear. Now, that being said, don't lie to your lender to game the game on this front, right? Mortgage fraud is a real thing and a federal offense, so don't get wrapped up in it. Just stay away, right? You should absolutely maximize your VA loan benefit, but do it ethically. Now let's talk about this pesky entitlement issue, right? So when you use the VA loan for the first time, there's no longer a limit to how much money you can borrow, depending on bank overlays, right? And your personal finances. That being said, for any subsequent purchases, you still have to worry about the VA loan entitlement amount. Now, this can get a little complex, so hang on tight, but I'm going to try to make it as simple as possible. Now, the Department of Veterans Affairs guarantees 25% of the mortgage amount. That's how you can get in 0% down, because the VA is effectively saying, we guarantee that they'll pay this, or we will if they don't, right? Now, if your certificate of eligibility, COE, shows that you have $100,000 worth of entitlement remaining, then you can purchase a home for $400,000 with 0 down, or more, provided you are able to pay 25% of the amount of money you go over your remaining entitlement. For example, if you bought a $500,000 home with $100,000 worth of entitlement remaining, you would need to pay $25,000 down. $100,000 eligibility equals $400,000 purchase plus 25% down towards the extra $100,000 that you're borrowing for this $500,000 home. Hope that made sense. The COE entitlement limits will vary depending on where you live in the nation. Let's talk about how your first VA loan affects your entitlement. Let's say that your first VA home loan was $200,000, which means that you used $50,000 worth of your COE. If you're looking to purchase your second home in San Diego County, where the 2021 VA loan limit is $753,250, you will have a remaining COE of $138,312.50. which would allow you a maximum purchase price of $553,250 before you would need to be required to put any money down. So run that back, $753,250 is the local entitlement amount. Divided by 4, because they're only covering 25%, that's $188,312.50 COE, right? Then you take out the $50,000 entitlement that you used on your first home, right? The one that was $200K that you already bought. That gives you $138,312.5 in remaining certificate of eligibility, like entitlement. which means that if the VA covers that amount, you could borrow $553,250 in purchasing power, and then anything over that, you would have to pay 25% down for every additional dollar borrowed. One-time entitlement recoup. So look, if you sell your home, you can recoup your entitlement once. It isn't an automatic process though, so like some people believe it is. So the restoration process needs to be done by the veteran, and the paperwork can be done online or by filling out a request for COE, right? The VA form 26-1880. And then you take that to the regional VA processing center. Now, residual income. So when you move out of your first residence and decide to rent it out, 75% of the gross rental income can be counted towards your debt to income ratio. Now that's a nice touch because it means that your first home will actually help you qualify for the second mortgage, or for the mortgage on your second VA loan purchase, as opposed to hurting your qualifications. The best thing you can do here is ensure that the rental income you generate covers the mortgage payment on your first home. Ideally, you want it to cover all of your expenses, but at least make sure it covers your mortgage. This is why you need to buy your home as an investment instead of just a home. The bottom line here is that the VA home loan is an incredible benefit, and you should definitely take advantage of it more than once. Using the VA loan to house hack is my personal favorite method for beginning your real estate investing journey, and I hope you will take advantage of it. Yes, you can use the VA loan multiple times. There are stipulations surrounding your specific situation, but you can use the VA home loan more than once. Now, I hear all the time people still saying that you can't use the VA loan more than once, and still saying that there's a limit on your first purchase. And just, there's so much misinformation out there about the VA loan because people just pass down what they've heard instead of doing some research. So I would just ask that if you got some value out of this, share this with someone. If you hear someone say one of those things, share this with them, or just share it on your Facebook or wherever, or pass it around. Help service members and veterans understand you can use your VA loan more than once, how to use your VA loan more than once, and that you can buy more house than you might think. There's a lot of misunderstanding and misconceptions about the VA loan, but it's incredibly powerful if used correctly. Overthinking the VA loan funding fee. The VA loan is one of, if not the most incredible financing options on the market, and yet people still try to find reasons to complain about it. It drives me nuts! You talk yourselves out of using the VA loan because the funding fee is terrible. Or you convince yourself that you need to put money down to buy down the funding fee because it sounds terrible. It isn't. So I'm gonna break down my thoughts on the VA loan funding fee here because I get asked this question all the time, and I just realized that there's a need for this breakdown to be in existence. First and foremost, what is the funding fee? The funding fee is essentially an origination fee, just like other lenders have, that is used to help keep the cost of the loan for U.S. taxpayers lower. Because the VA loan doesn't require down payments or monthly mortgage insurance, this is kind of a requirement. It is what it is. So the funding fee is wrapped into your mortgage, and it's paid when you close the VA home loan. This funding fee is a downside of the VA loan, but it really isn't that bad. So on a $200,000 property, the funding fee is only like $4,600. Assuming you were to pay 4% interest on the loan, this funding fee could cost you a whopping $22 a month. So in my opinion, paying $11 a month for every $100,000 in loan amount is absolutely worth not putting 20% down in order to use a conventional mortgage, right? So home loan funding fee amounts differ, but you know, it is what it is. It's 2.3% for your first use and 3.6% for your subsequent use if you put no money down. If you put 5% down, it's 1.65, and if you put 10%, it's 1.4. So really not enough of a savings there to justify having to put $5,000 or $10,000 down per 100,000. Now, funding fee amounts for other VA home loan types, like the IRRRL is a 0.5%. Manufactured home loans, right, like a mobile home, it's a 1% funding fee. If you're assuming a VA loan, it's a 0.5%. If you're using the Vendy loan for purchasing like VA acquired property, it's 2.25%. If you're doing like a Native American direct loan, a NADL, that's 1.25 or a 0.5% for your subsequent use. And if you're doing a VA-backed cash out, it's the 2.3 for first time and 3.6 for, and I'll put a table in here so that that looks better, but, or you can look at the article. Now, circumstances that waive the funding fee, right? So the most commonly known way to avoid paying the funding fee is if you have a VA rating of 10% or greater for your disability rating. That said, there's several other ways. I went ahead and just copied it straight from the VA Gov website because it's really just a good breakdown, right? So you won't have to pay a VA funding fee if any of the below descriptions is true. If you're receiving VA compensation for a service-connected disability, or eligible to receive VA compensation for a service-connected disability, but you're receiving retirement or active duty pay instead, or the surviving spouse of a veteran who died in service or from a service-connected disability, or was totally disabled and you're receiving dependency and indemnity compensation, DIC, Duke, or couldn't resist, or a service member with a proposed or memorandum rating before the loan closing date saying you're eligible to get compensation because of a pre-discharge claim, a service member on active duty who before or on the loan closing date provides evidence of having received the Purple Heart. You may be eligible for a refund of the VA funding fee if you're later awarded VA compensation for a service-connected disability, right? So you just got to ask that question. Now, the effective date of your VA compensation must be retroactive to before the date of your loan closing if you think you're eligible for a refund. If you think you're eligible for a refund, please call your VA regional loan officer or whatever at 877-827-3702. All that's on the article, right? So they're open and they'll be happy to talk to you. So why is the VA loan funding fee better than using the FHA loan? If you focus on the negative view of, but the funding fee stinks, you'll somehow come to the conclusion that the FHA loan could be your better option. And let me just tell you that this is dead wrong, right? I got talked into using my FHA loan to buy my first duplex by my lender, nonetheless. And that has cost me well over $10,000. And if you watch some of my other VA videos, you'll figure that out since closing on the property. The VA loan is much better. The first reason is mortgage insurance premium. The FHA loan requires that you pay a mortgage insurance premium, which is 1.75% of your loan amount. So right off the bat, on the $200,000 home example, this is $3,500. So keep in mind that the funding fee is not charged up front, but rather wrapped into the loan and paid down over the course of the mortgage, right? So that $3,500, the MIP, that's up front. Now, there's also private mortgage insurance, PMI, right? So to make matters worse, this PMI is added to the FHA loan as a sort of ongoing mortgage insurance premium. This PMI ranges from 0.45% to 1.05% of your original mortgage amount, depending on the amount of your loan. So on our $200,000 home, the PMI would be 0.8% or $1,600 annually. This loan, on this loan, PMI would equate to $133.33, and then a whole bunch of other threes a month added onto your loan payment. So here's a short down and dirty comparison of the difference between the VA funding fee for the VA loan and the mortgage insurance premium and PMI payments on the FHA loan on our $200,000 example. So with the VA loan, you would have taken the funding fee and you would have it wrapped into the mortgage. You would pay $0 up front on it and roughly $22 a month for the duration of the loan, totaling $4,600 over the course of the loan. With the FHA loan, you would pay the $3,500 mortgage insurance premium at closing, and then you would be responsible for paying $133.33 monthly in PMI in addition to that, right? So, and after just 1 year of ownership with the FHA loan, you would have paid $5,100 between MIP and PMI, and you'd still be on the hook for $1,600 a year in PMI expenses until you got below that 80% threshold. Oh, and by the way, try to convince your lender to waive the MIP and PMI expenses on an FHA loan just because you have a VA disability rating of 10%. Let me know how that works out for you. They don't care. The VA loan is $0. The only way to get rid of MIP and PMI expenses is to put a lot more money down than you want to, right? Like if you put 20% down, you probably wouldn't have these, but why would you do that if you're trying to use one of these low down payment options, right? Like it doesn't make sense. It's kind of counterproductive. So again, the funding fee isn't that bad. The VA loan is an incredible benefit for service members. All right, so why shouldn't you worry about the fee? The bottom line is that the funding fee does cost you a little bit of money, and it does get wrapped into your mortgage. It might mean that the VA loan is not a perfect, zero down, no money, nothing ever, wonderful, whatever, but someone's got to make some money, right? Like there's got to be something for this benefit. So it doesn't, however, ruin the VA loan. I hear negative people comment about, oh, but the funding fee sucks all the time. And the reality is that the funding fee is substantially better than what you would pay on other affordable primary occupancy loans. Personally, if I was to buy our $200,000 example house, I would much rather pay $22 a month than have to cough up $40,000 as a down payment. Now, I say that without even going into the concept of opportunity cost and the present value of the money But just for sake of argument, if you had the money for the $40,000 down payment, you could stick it into even just a crummy savings account. Just a savings account. And as long as you earned 0.0066% interest, you would earn enough interest to cover the funding fee cost. My bet is that you could invest $40,000 almost anywhere for more than 0.0066% return on your investment, which is exactly why you should not complain about the funding fee. It is chump change. Like, who cares? Now, I would like to throw this disclaimer out there real quick. I'm not licensed in any capacity to work with mortgages. I just do my homework. I also did this math on a desktop calculator, so if the numbers aren't perfect, they're just rounded, whatever, I apologize, but you get the idea, right? And that's the point, is getting the idea. Also, these fees do change from time to time. How to qualify for a VA loan without income, because your income will end as you're exiting the service. For example, if you're getting out of the military in 6 months, your lender's not going to be able to use the income for the military service income to qualify you for the mortgage. Puts you in kind of a weird spot, because if you were planning to buy a home as soon as you move back to your home of record after exiting the military, you know, it might not be as convenient as you want. So this video has been a long time coming, and I have no idea why I didn't record it sooner, but now I have more information. I want to help you guys out, and I want to give this all to you, right? So now, I hope this video helps give you some ideas, but just know going forward that the answer isn't as simple as you would hope. So the first is VA disability income. Now, I listed this one first because it's common these days for service members to receive disability income. So did you know, and you probably didn't, but if you didn't, VA disability income actually counts as 1.25 times the amount you receive when factoring for debt to income ratios, right? So just to make sure that this is clear, that's right. If you earned $1,000 a month in disability income, your lender will actually count it as $1,250 a month. Now, the reason is that your disability income is tax exempt, and so they count it as what the equivalent pre-tax ordinary earned income would need to be in order to net your disability income amount, right? Now, I've seen veterans qualify for mortgages based solely off of their VA disability income, including a $400,000 and some change home in Texas, I believe, with a veteran who was 100% disabled. So totally possible. Number 2 is retirement or IRA distributions. This one's fairly straightforward, although I don't believe it'll apply to the bulk of our younger audience. If you receive a pension or distributions from your IRA or 401k or other retirement vessel, that can count as income that you can use towards qualifying for your loan as well. Number 3, spouse income. So this is another one of those obvious answers, but people don't always realize that you can utilize it. Your wife or husband has a job. You can use their income toward qualifying for the loan. For example, my wife is a high school counselor, and she has been for the last 2 years. Actually, she has like 13 years experience, but at this specific school. When I exit the military, I could utilize her income to improve my debt to income ratio when qualifying for a VA loan. So as long as we qualify with her income and not mine, then none of the rest of this matters. So that's one advantage of if you wanted to like send your spouse back home to get a job prior to exiting the military, they would have that record of income. Although I have done this in just about the last 2 years of my time on active duty, and I don't recommend it for a quality of life standpoint. So financially, logistically, like it kind of makes sense, but from a quality of life standpoint, not ideal. Miss my family, so you know. Number 4 is one that I get asked a lot about, but get a job offer letter. So if you have an official job offer letter to begin employment with a company upon exiting the military, you can use that income towards qualifying for the VA loan. This will show continuity between your current income and the income you will be receiving upon exiting the military. This letter needs to be official, show the salary you'll be receiving, the date you'll be starting employment, location of the job, and any other pertinent information regarding your situation. Anything that isn't regular W-2 income cannot count towards that income. That means you can include your salary or hourly wage from this job offer, but not anything commission-based or related to bonuses you may receive, because that's not guaranteed. Please note that you're going to want to talk with your lender to clarify exactly what they want to see in this letter and ensure that your employer is legit. The last thing you want to do is use income from a job that you aren't actually going to be working and then wind up getting foreclosed on because you can't afford to make your mortgage payments. Number, I think we're on 5 or 6, I've lost track. 75% of your gross rental income. Now, this is one of the reasons that I love house hacking so much. Let's say that Jimmy buys a fourplex and the market rent is $1,000 per each of the units in the house, the house that he's buying, right? Now, because Jimmy plans to live in one unit and rent the other 3 out to tenants, he can use 75% of the $3,000 that those units can reasonably be expected to rent for towards his mortgage payment. In this specific scenario, Jimmy can count $2,250 worth of the rental income, 75% of $3,000, towards his debt to income ratio. Now, the catch here is that this $2,250 only counts towards the mortgage payment. Any of this rental income that is left over after being used towards his proposed mortgage payment will not count towards debt to income ratio. It'll just kind of disappear. So just to clarify that, it counts towards your principal, interest, taxes, insurance, PITI, not just the mortgage payment itself, but your PITI. So, you know, it's very useful, but just keep that in mind. The next, maybe 8, cosign, 12.5% down. Contrary to popular belief, you can partner with a non-veteran or non-spouse to use the VA loan. The downside is that the other person will need to bring 12.5% down to the closing table. That being said, 12.5% down is still better than 20% down, so this could be worth their time. Although personally, I wouldn't pay 12.5% down for a primary residence when there are other options like the FHA loan or even a 5% down conventional loan, which is less for owner occupied, right? So those are probably better options. The only real situation I see this making sense in is if your partner has the 12.5%, but not very good credit or other reasons that wouldn't be able to qualify for the loan on their own. The caveat here is that I don't know if I would want to partner on a home with somebody who wouldn't be able to buy the home on their own for financial reasons, right? So, you know, that's still an option nonetheless. Now, the last option, I think this is the last option, if I remember correctly, that I put on here. I think we're on 8 now. Partner with another veteran. Now, you most likely put 2 and 2 together when I mentioned partnering with a non-veteran, but yes, you can partner with another veteran as well. I have a couple of friends who have done this, and one set that did it specifically for this reason. One of them makes a lot of money, but it's in a new job and didn't show the income on the tax return yet, and since it was commission-based, it has to be on the tax return. The other had a tax return to back up their income, and so they collaborated to purchase a badass triplex in San Diego. Now, there are several situations in which it would make sense to purchase a property together, but the most common two I have seen is when one member cannot show income required to purchase, or they want to combine their income in order to qualify for a larger property. Again, remember, tax returns need to show income. So in order to crush the income requirement, the best thing you can do is have tax returns for the last year or two showing your income. One of the things a lot of service members do is try to get as close to zero on their taxes, and this is not just service members, this is everyone, especially like real estate investors. And while it's great from the standpoint of paying taxes, it does nothing to help you when qualifying for a loan. So if you're self-employed or like a real estate investor and you're showing almost no income for taxing, it's gonna bite you when you try to qualify for this loan. So let's say you brought in $80,000 in rental income last year, right? After all the expenses, you showed a net cash flow of $1,000. Then you're only gonna be able to use $1,000 towards helping you qualify for the loan you're applying for. While you wanna save money on taxes, just make sure you do it in a way where you still show enough income to qualify for a loan if you need it, right? It's kind of a delicate balance. Now, for this reason, it is sometimes best to bite the bullet and show some taxable income in order to showcase that your business is actually making money. That might be painful from a standpoint of paying taxes. It can be quite beneficial for qualifying for a loan. So you've got to kind of weigh pros and cons there. Now, I want to touch on some brutal truths about ways to qualify for a VA loan real quick when you don't have income, right? The reality is that you may not be able to qualify for a loan at the time that you transition from the military. Now, while that isn't what you want to hear, it's further proof that you need to plan ahead and get your ducks in a row before exiting the military. There are several income streams that I get asked about all the time, and I do mean all the time, which simply do not count towards your income. I want to make sure I outline these right now for 2 reasons. First, because people just don't know, and I feel the need to put this information out there in order to help you and be a valid resource for you and your family and to reference. And secondly, because let's be honest, I'm really sick of having to explain this all the time. Like, I can only send the same type of text a million times, and I can only save so many text formats, and So now I can point someone to a video that'll actually answer the question better than I would be able to in a short text anyway, right? So the GI Bill. No. About sums it up. I don't care what your mama told you or what the school you go to or how much the basic allowance for housing is for the GI Bill. Your BAH from the GI Bill does not count towards your income at all. The reason's simple, right? Income is guaranteed to disappear in the near future. Why would a bank give you a 30-year loan based on income that won't even last 1/6 of that time? Because at the end of your GI Bill, no more of that income, right? So hopefully that explanation makes sense, because there's no world in which you can use the income from your GI Bill or the BH related to your GI Bill at all that it can be used to qualify for a loan. Sorry, not sorry, just the way it is. Yes, it would be nice if it could, but it can't. Sorry. So side note, in case you can't tell, this is the #1 question I get about income used to qualify for the VA loan. And people genuinely try to debate me about this, about why this shouldn't be the case, as though I have some power to change the banking industry's perception of risk. Just no, you can't use your GI Bill income. Sorry. Side hustles. Side hustles are another very common income stream that people ask about. And as much as it pains me to say this, you unfortunately cannot start driving for Uber today, make $200, extrapolate that out to show that it would be $73,000 a year at that rate, and qualify for a loan. And don't get me wrong, these side hustle jobs, the income can count toward qualifying income, only if you have tax returns that back up how much you are earning this way. Many people hide their side hustle income or bounce from side hustle to side hustle to side hustle, and unfortunately, in either of these situations, you're just out of luck. Now, what you can do to take advantage of the side hustle income is utilize it aggressively to pay down your consumer debts. That's going to improve your debt to income ratio and can help your other income streams stretch a little further for qualifying for a loan. So yeah, I think that's simple, right? If you use your side hustle income to pay down your debt, then it's helping you out. If you use it to just buy new toys, you know, cool, but it's not really helping you out. You just can't find another solution. So before you get upset and you say, it's bullshit that this doesn't count, try thinking of it from a bank's point of view. Anytime a bank lends money, they're assuming a certain amount of risk. Now, it's in their best interest to assume the least amount of risk while lending money, their money, to people. For this reason, you need to be able to verify the amount of money you earn. To put this in real estate investor terms, would you buy an apartment complex if the landlord had no way of proving how much money it brought in over the last few years? Or if it made any money at all? Now, hopefully not, but the same is true for the bank. They are investing in you, and you need to be able to prove that you are a safe bet for repaying the loan. That's the way it is, and you're not going to be able to change it. Now, what is the best thing you can do to help you qualify for a VA loan when exiting the military? The best thing you can do is get a solid job and show a competitive income. Focus on finding the solution to help you be more competitive for your loan, as opposed to focusing on the downside that you can't qualify right now. Also, do not commit mortgage fraud, and don't try to lie about any of this. It just simply isn't worth it. So hopefully this tough love video helped clear some things up for you, and I look forward to hearing about your success stories on that first or next purchase.